few words.
Thank you, Carrie. Welcome, everyone. We're glad to have you here with us today as we dive into the quarter one of 2024 and look at some of the a little bit of an economic update as well as our sentiment study. So for those of you who completed the survey this quarter, thank you very much. It's very important and very helpful. For those who didn't, please look for it next quarter and make sure that we have your insights represented as well. We're going to go ahead and get started. We have two presenters with us today. Joe Bates, who is the Senior Research Consultant at the ACEC Research Institute, and Thomas Grogan, our Senior Director of Economics and Private Markets at ACEC. So they're going to share some insights that they have. As Carrie said, please feel free to put your questions in the chat or the Q&A. I'll be watching out for those and giving Joe a heads up as those come in. We'll try to get to as many as we can. Joe, I'm going to go ahead and turn it over to you.
All right, thanks, Daphne. It's great to be here again today. I see lots of familiar names on the attendee participant list today, so welcome again to those of you who have regular watchers and viewers, and welcome to those new folks today. And it's great to have you here, Thomas. As always, I think you have been really, helped us to add more flavor to this roundtable and a lot more data, which I know everybody loves as well. So we'll have a typical agenda today. How is the economy doing? As Daphne mentioned, we'll talk about the broader macroeconomic trends. Then we'll talk about how the AE industry is doing today, and then we'll talk about how the future looks for us. All right, so how's the economy doing? Well, US GDP in the fourth quarter of last year came in hotter than expected. They did revise down Q3 just slightly, but the fourth quarter did come out much, much higher than had been anticipated. So as those of you who have listened to us regularly know, we keep talking about this, the longest awaited recession in the history of the United States. Well, we're still waiting for it. And we'll talk a little bit more about whether we think we're going to have one or not when we turn towards the future. But at the moment, things are very good. Again, GDP came in at 3.3% in the fourth quarter. So what you want to do when we get the first quarter reading, which won't come out for a couple more months, but when we get first quarter of 2024 reading, you want to look and see whether it comes in higher than expectations, at expectations, or lower. And, that'll give us this indicator of how things are trending this year. We also have a very robust job market. You can see, this is a slide we also share on the regular. The unemployment rate has been steady at 3.7% for the last several months. It's inched up just slightly, from sort of the lows that we saw of 3.4%, but we're holding pretty steady right now. And last quarter, when we presented this information, I talked about how we were, and I stress we're, seeing a little bit of a slowdown in job growth, not a decline by any means, but the first half of last year, things were moving along very, very nicely and very strong. The second half, things started to slow down just a little bit. But then in December, and we had 300,000 new jobs created, and in January, 350,000 new jobs. So the job market seems to be heating up again. And we'll also talk about labor shortages, as we have seen for quite some time now. On this slide, this shows you the particular sector of the economy in which the engineering and design services resides. That's in the professional and related occupations. We like to show this because it gives us a little bit of a drill down closer to our sector of the economy than what you see at the broad level. And you see there that the unemployment rate is at 2.1%. It's been hovering between 2 and 2.5 for at least the last year plus. So again, we just don't have a lot of people available for the jobs that are being created, but we are creating tons and tons of jobs right now. One thing I wanted to share with you all that I haven't shared previously is consumer spending. This is, of course, the main driver of the economy in the U.S. And we've seen very strong numbers through the last few months of last year. Consumer spending was up 0.7%. That's month over month in December. And in November, it was up 0.4%. So those numbers have been coming in pretty strong. And we just got our new release this morning. That number came in at 0.2%. So that's actually a good thing, because what the Federal Reserve is doing is they're waiting on interest rates right now. As most of you know, they ratcheted them up very, very quickly, and now they've hit pause. They're not increasing them anymore, and everybody's expecting that they might start to decrease them at some point. Well, what they're looking at is not only consumer expenditures, but also consumer expenditures price index. They look at that more so than they do even the consumer price index. So, and those numbers are moderating as well. I'll throw those out in a minute. But again, we're seeing, good numbers. The market reacted very well today because we didn't have sort of an overheating of those consumer spending numbers. And so that's sort of a good news story here. One of the challenges that we continue to face is in the labor force participation rate. So this is the percentage of those who could be working, adults who are working. And we've talked at length for a while now about how, there's been a historic decline as baby boomers were retiring from after the 2008 recession. We just saw more and more baby boomers leaving the job market and retiring. They are counted as potential workers because they could work potentially, but they're not. And so then we started to see a slight increase from 2016, and then we had the pandemic, of course, and we have not returned to the levels seen since the pandemic. And so it doesn't seem like a big difference when you see 62.5% versus 63%, but that 0.8% percentage point, it's about 2 million jobs. So we really need to have 2 million people, I should say, who would be available for working. And we certainly could use more people available for working right now. All right, so the first slide from the sentiment study that I wanted to share with you is about inflation. And this is a really, really good number. So we see a lot of good news in our presentation today. There's a couple spots that we're going to throw up some caution flags, but mostly we have a lot of good news to share with you. And on the inflation front, we see that our firm leaders, and this is from about 600 or so ACEC member firm leaders who respond to our quarterly survey, and we see that net rating is a plus 39. So just to let you know, this net rating system we use, we take the positive responses and we subtract the negative responses from those, the percentages of them, and that's the rating that we get. So you could have a positive 100 or a negative 100 at the extremes. And what we see here is concern over inflation is coming down. It came down a lot over the last quarter. So this is very, very good news.
Joe, this is, if you could just go back for a second, this is one actually where we want the number to be lower, right? Most of our sentiment scores, we want to see that number increasing. This is one where it's kind of the reverse effect and we want to see it going down. So this is good news. And actually have a question that has come in related to this. Do you see any difference on the size of firm or maybe geographic differences related to inflation concerns?
Yeah, so that's a good question, Daphne. And we don't really see a lot of variations by the geographic regions on this particular measure, but we do see some differences by firm size. Smaller firms seem to be a little bit more concerned about inflation this year. And by small firms, I mean those with 1 to 25 FTE. That net rating for those folks is about a plus 50 or plus 52. So it's definitely a little bit higher. But the larger firms, those with more than 500 FTE, they're not at all concerned, really. We have almost it's about a plus 19 on the net rating. So it definitely does differ by firm size.
Great. Thank you, Joe.
Sure. All right, so when we do look at the CPI numbers, the good news is that we're down significantly from the height in June of 2022. And that is because the Federal Reserve has been tightening the monetary policy. But we're kind of stuck now. Ever since about last September, actually June, sorry, on this measure, it's June, we were down at 3%. And now we're still at 3.1%. So we've been going sideways a bit. And I think this is why, I'm sort of saying, I don't think the Federal Reserve is going to start lowering interest rates in March, maybe June, I don't know. But a lot of folks had been hoping that they would start to ease rates in March. And I just don't see that happening with, more than full employment, a very strong job market, kind of sticky inflation here. It's not getting down to that 2%, which is what they want to get it down to. And so I'm thinking that we're not going to see them cut rates in the next meeting in March. Thomas, I'd love to get your thoughts on that as well.
Yeah, no, I mean, I think you nailed it, and that 3.1%, and we'll dive into it a bit deeper. Those numbers are still higher than would be expected or what the Fed is hoping to have, with respect to costs and everything that's happening. So I don't think there'll be any cuts in March.
Yeah, and there was a recent interview with the Fed chair, Jerome Powell. This was just a couple weeks ago, and he said that they're not going to wait for the inflation numbers to get to 2%, but they want to make sure that it's going to get to 2% before they start to cut rates. So I think that was, to me, that indication of, yeah, we're holding steady, but we're not quite ready to cut rates yet. And one of those numbers I wanted to share with you from earlier, and again, this is the Fed's preferred measurement of interest rates, or inflation. And it's what's called the PCE price index. So that came out this morning as well. And it did come down from December. So the year over year PCE price index is at 2.4%. That's down from 3.4 in September. So those numbers are moving in the right direction. But again, I don't expect we're going to see a price or the interest rate cuts in March. Now, when we look at the core rate of inflation, this is when you strip out the more volatile food and energy prices, we see that inflation is actually a little bit higher right now than the headline number. It didn't get as high as the headline number when it topped out at 6.6%, but it's not gone as low either. So it's also started to move sideways. You can see since September it was at 4.1%, and again now we're at 3.9. So there's kind of a mixed bag here. It is good news that it's come down, but we still need those numbers to come down a little bit further. All right. So Thomas, I know you have some numbers you wanted to share with us as well.
Yeah, I guess, going back to what we were just discussing in terms of how much inflation has changed and prices have changed, and what does that mean for the future, for the Fed cutting rates for households and businesses. Having a decline in inflation is not the same as deflation, and so what we see is really kind of regardless of whether we're including the more volatile food and energy commodities in our price indices, things are still now like 21% more expensive than 3 years ago, right? And it's not coming down. So with the prices rising, wages need to kind of keep up for it's a circle, right? If you have the higher wages and you're working, then you can afford to keep buying the same amount of stuff today as you were buying 3-5 years ago. And so, the big question is kind of how long can this be sustained? As we will probably talk about, in order for if prices are going up, but household consumption to continue to go up, that basically means wages and income have to go up as well, right? For everything to be in this kind of equilibrium. So this is really just another way of looking at, while we made a lot of progress and we could see these lines have really started to flatten out for the past 6-8 months, things are still just more expensive than they were before, and that's kind of what people remember.
And I think that's a really important perspective, Thomas, that in really just 3 years, we've seen huge amount of inflation, and just the cost of everything is higher than it was. So I think that's a great perspective to put this in.
And so, yeah, I mean, to dive in further, when we think about what firms and businesses and people spend money on, you're basically spending it on goods or services. And we actually are seeing in the most recent few readings, the price of goods has actually started to trend down, meaning they are getting cheaper. However, the price of services, we're seeing this divergence, and those are continuing to increase. And so, that overall composite CPI that's taking into account everything, when you start to break it down by its kind of principal components, the services cost is very sticky and very tough to try to get under control. And, at least for households, about 70% of your household budget is going towards services. So I think that this is something that will, kind of need to be continued to be monitored, because while the price of a Snickers bar or sneakers might be a little bit cheaper or the same compared to a few months ago, the total cost of being served your coffee or your haircut or anything like that is just still continuing to rise. And speaking of these rising costs, what we see now on our engineering AEC world is that on our left-hand side, for total project construction costs, specifically in the non-residential sector, while it has come down a bit from last year's highs, to deliver a project today is still basically 41% more expensive than delivering a project 5 years ago. But really, most of that cost kind of started to occur or started to grow in early 2021, in line with some of those CPI readings as well. What we see on the right-hand side is the engineering services index is still going up a little bit. It's not, let's say, accelerating up. It's almost plateaued the past few months, but engineering services, which are going to be a function of really what the cost is to deliver engineering work, which is primarily time, material or labor costs, is about 17% higher than pre-pandemic. So, project delivery costs are still significantly higher now than they were 3 years ago.
And I think, again, this puts it in a great perspective that, even though we're seeing a leveling off of the inflation, it's just so much more expensive all around than it was a handful of years ago. And I always like to show, the consumer side of things as well as the industry side, because they're very much tied together. We can't separate our industry from what's going on in the world around us. And I always like to remind people of that. All right, so Thomas, I think you've got a couple slides here as well to start us off with. And how are we doing right now in the AE industry?
Well, from a top line revenue perspective, we're continuing to grow. We're up 5.2% year over year, though you do see a bit of a plateauing over the past 4 quarters. Quarter growth was 0.2%, so almost flat. However, compared to even just 4 years ago, when we were having negative growth because of the pandemic and COVID shutdowns, that recovery happened pretty quickly. And we're really at this all-time high in terms of revenue. We'll see on the next slide, we're also kind of at all-time highs and flattening with respect to our labor. Really what we're kind of hitting is a bit of a capacity, I think, challenge where you can only do work if you have employees to do the work, to take on the work. And so we're kind of at a bit of, a plateau. And as you can see here on the left side, that year-over-year growth is starting to come down a bit from those double-digit levels we saw at the end of 2021, early 2022. Good news is for this past month, I believe we had the highest month-over-month growth in AE services employment since, I think it was March 2022. So we have been able to fill some of these roles, not a lot, but we're kind of really at that capacity limit.
Hey,
Yeah.
Thomas.
Yeah.
Oh, sorry, Joe. I was just we had a kind of a comment question come in, and I think maybe you touched on it a little bit, but maybe there's a little bit more either from you or Joe. So if you go back, Joe, one slide, we were seeing kind of a nice steady climb over the past several months, and now we're seeing this flattening. And I think you talked about, sort of the capacity issue. Is there anything else you're seeing there as to why the flattening?
Yeah, so one thing, and we'll get into this when we kind of get into the sector specific data, is the infrastructure industry as a whole. There's a bunch of different components. As these interest rates have been rising, the residential sector is kind of, I don't want to say crashed, but it's had negative growth, right? So that was coming down a lot. That was being offset by a lot of growth in the manufacturing sector and some of these other big, heavy civil sectors that, let's say, are less sensitive to the interest rate increases over the past 15 months. So it's kind of, let's say, the period of right post-COVID, 2021, early 2022, when we were seeing this 10-15% growth, everything was booming. Once the interest rates started to rise, the sectors that are really sensitive to interest rates, specifically residential, to a certain extent, commercial and office, we're not seeing that level of growth. So it's kind of, there's a flattening in the aggregate because we're measuring different sectors that are growing at different rates, and they're kind of netting out at this flat level. And then also a bit of the capacity issue that we mentioned.
Thanks.
Yeah, so I think the uptick in hiring is good. The fact that we are able to add more employees to these firms. This also, though, if we think about that cost of engineering services slide that we showed previously, that also means that's going to have to kind of continue to go up when we have such a tight labor market. You're going to have to pay, really a wage premium to get folks to work.
I know, Joe, you have some information about that coming up too from the sentiment study.
Yeah, we're going to definitely talk more about the labor market in a few minutes. But I want to show you another slide that we like to watch from the sentiment study. This is one of our flagship slides, actually, one of the key indicators for our industry. And what we see here is that current economic sentiment when it comes to the U.S. economy has gotten up to a plus 35 on that net rating. So this is a very, very good move and a very good solid number. Our low point was a negative 15 in the third quarter of 2022. That was a lot of, there were a lot of low points in that quarter, but we're about a year and a half out from that now. And we have seen steady improvement in the current economic sentiment. And when we look at, of course, the engineering and design services industry sentiment, as well as firm finances sentiment, these numbers have been high. They have never, well, there was one quarter, I think, Daphne, where I remember that was 79, plus 79, but we have been in the 80s ever since we started this study back in about 10 quarters ago. The high point for the US economy was when we first conducted this study in Q4 of 2021, and it was at a plus 40 at that time because we were all sort of breathing a sigh of relief that we were finally starting to come out of that pandemic challenges. So good news again there. And this is one of the slides that we're going to talk about for a couple minutes because a lot of interesting things going on here. This shows you the sectors in the industry. It shows you the last 4 quarters and the current quarter. And so we can look at the change from the previous quarter as well as the change year over year. And I think that's where we really want to focus. So those circles are on the areas where we have the highest current sentiment. And again, we're in the plus 80s here, so you can't get much better than that. And these are all airports, transit, roads and bridges, wastewater, energy and utilities. I mean, these are all very high numbers. And these, of course, are those IIJA impacted sectors. And what we also see then in the year over year is that these have improved year over year, and we have just been growing in those areas. There's other areas which we've seen a little bit of a softening, particularly the bottom there. You see that commercial real estate is down 20 points over last year. And again, remember, this is current sentiment. So there have definitely been some winners and some losers. And Thomas, you alluded to that earlier. So not surprising to see these numbers, but very interesting that there's sort of some haves and some have-nots here. But overall, all the numbers are positive still.
Joe, so I have 2 questions that have come in. I'm going to take the one that's related to this slide first, and then one I want to go backwards a little bit. So on this one, I think the thing that they're pointing out is the science and technology, right? Plus 13 year over year, plus 77 for the quarter, really high numbers. I don't know, Joe, or maybe Thomas, you have some insights into that science and technology, what's happening in that space.
Yeah, I think that has been a space that has had a lot of macro headwinds that were building up even before, let's say, the pandemic, but then got a little exacerbated by it, is just the growth in that industry in general in the economy, right? So there's a lot more pharmaceuticals, a lot of more pharmaceutical items being manufactured. You know, one aside from AI, probably the second most popular thing in 2023 was Ozempic, and that's like not an insignificant impact. Drugs like that have been growing, and the also general theme of having more facilities on shore that got exacerbated by the pandemic and all the supply chain stuff just led to a lot of these private, you know, Eli, Lilly, Gilead, all these companies that are doing biopharma work, investing and spending a lot on these facilities in the US.
And I think the data centers, you know, that one's not surprising. Especially if you live in Northern Virginia, which is the largest concentration of data centers in the world. These buildings are going up every week. There's a new one on 66 out, you know, halfway between me and DC. It's literally more than a quarter mile long. It might even be a half mile. It's humongous. It's just crazy.
The other question, Joe, that has come in is back to the AE revenues slide. And I don't think you necessarily have to go back there. This is, you know, where we talked about sort of the nice increase was happening and then the plateauing. And so they're asking the gross revenues are growing. Is that expansion in the market, or is it inflation pressures on wages and benefits and other costs? So, are profits growing, or where is that growth coming from?
I can take a stab at that, and then Thomas, I'd love to hear your thoughts. We know from the economic assessment that we conduct every year that inflation is certainly pushing up some of those numbers, but we are also seeing real growth as well. So it's both. It's both. And I don't know, Thomas, do you have any data on profit margins or any of that, just to know what that's indicating?
No, I don't have that. I will say that, depending on the sector, inflationary pressures could be like 60 to 80% of what is causing these increases in nominal values. It really just depends a bit, but happy to follow up offline with some of that research.
Great. Thank you, gentlemen.
All right, so Thomas, this one's your slide here.
Yeah, so this is basically recapping how the value of construction put in place in 2023 looked like by sector compared to 2022. And what we see, no surprise, all throughout the year as we were doing monthly or quarterly updates, the manufacturing sector had the largest, significant increase in project spending spurred by all the Science and Chips Act, IRA programs, as well as the general trend of onshoring. But also, really almost every industry had pretty robust growth. The one exception being residential, which had negative growth, which was a direct impact of the rising interest rate environment. But I think this slide really speaks to how much growth and this, in terms of overall GDP, this construction AEC space really helped buoy the U.S. economy in 2023. And I think for the total year over year, we were up about 7%. I think we ended the year just shy. I think it was $1.98 trillion spent across all these different project classifications.
Yeah, and although my sectors don't match up exactly all the time with your project classifications, they're pretty close. And again, I think this just puts some real data behind the sentiment, where we've seen positive sentiment all year long, with, again, the exception of residential and possibly commercial real estate. But this just, I think, reinforces how strong our industry is. And I wanted to point out something you sort of said quickly, that this really does help power the U.S. economy, because we know from our economic assessment work that for every dollar spent within our industry, we're adding 1.5 or $1.60 to U.S. GDP. So it's a great multiplier and a great help to the economy. We also take a look at backlog regularly. This is, again, it's from the sentiment study. We ask firm leaders how their backlog is doing compared to 3 months ago. And again, things had sort of softened a little bit until this quarter, where we sort of leveled off, and so that's good news as well. And we look at another metric, which is the actual months of backlog, and we've been very, very steady here for the last several years now, around that 11 month median. This is the median number of months of backlog. And of course, when you look at the backlog months, we have differences from smaller firms to larger firms, and that's just sort of the nature of the beast. But all firm sizes have seen very steady and very healthy backlog trends. So it's very good news, I think, for our industry. All right, so let's turn our attention now to the employment situation within our industry. We asked firm leaders how many open positions they have right now at their firms. And we, again, as we have been seeing quarter after quarter, about 9 out of 10 firms have open positions currently at their firm. The median actually increased from 4 to 5. And if you look at the sort of teal colored bar at the more than 10 level at the bottom of the screen, that went from 26% of firms reported more than 10 openings to 32% of firms reporting more than 10 openings. And we also see continued increases in the number who have between 3 and 10 openings. So you can see here, that's why that median is getting pushed up. So lots of open positions in the industry. And when we look at it by region as well as by firm size, again, we haven't seen that much change year over year. And even from quarter to quarter, we tend to see some more volatility in the regional data. But looking at it year over year, again, not a lot of change there. One thing that we've seen a bit of change, and it's more of a fluctuation, is in firms with more than 500 FTE. We've seen it go from 80, a median of 80 openings to 100, down to 93, back up to 100. And we actually have a very large number of firms in this category who participate in the study. It's around 150 each quarter. So there's just tends to be more fluctuation in that particular line, but still, very, very solid numbers here in terms of job openings. And we also started tracking last year, we started to calculate, I should say, the open number of positions divided by overall FTEs. And this gives us a metric of how many positions are available out there. And we see that 9% of positions in terms of overall FTE are currently open and available. This does increase a little bit when you look at the 1 to 25 FTE firm size. That's mainly a function of numbers. If you have one opening out of 8 people at a firm, that's obviously a higher percentage. Or if you have, 2 out of 10, that's 20%. So some of that's in numbers games, but still, nonetheless, as a percentage, we see that smaller firms have more openings on average than larger firms. Although the absolute number of openings is, of course, much higher in those larger firms. So that's kind of the current situation that we're seeing right now in the industry. And let's take our crystal ball out, Thomas, and see into the future a little bit. Let's see what the future holds for us. So this slide here is from our economic assessment that we released at Fall Conference back in October. And this, again, I think addresses part of the question that we had earlier, how much of the growth is from inflation and how much is real. So if you look at the bottom of the slide, you see the percentage of nominal output growth, and then you see the percentage of real output growth. So you can see in 2023, as you said, Thomas, a good chunk of that nominal growth is inflation, but still having a real growth of 3.3% is very, very good. And we're looking in 2024 now at a real growth of 2.5%. Then in 2025 and beyond, we start to see it sort of getting back towards what we might call a trend, not quite as strong as we've seen in the last couple of years, but certainly very healthy growth percentages. We'll also see inflation coming down by 2025 as well. That's what we're anticipating with this forecast. So very good news overall. Excuse me. So from the sentiment study, we look at future sentiment. So this is asking firm leaders, what do they think about the economy? How will it be doing 12 months from now? How will the engineering and design services industry be doing 12 months from now? And we saw great improvement in the performance of the U.S. economy when it comes to future economic conditions. And that was an increase of 25 points. So that's really, really strong. And we saw the low of -40 again back in Q3 of 2022. So we're well off the lows of the sentiment regarding the future sentiment of the U.S. economy. Our previous high also was back at the first time we conducted this study. It was a +6. So our future sentiment is actually more positive than it's been in the last 2+ years. And that has definitely led to a better outlook for the industry as well as for firm finances. Both of those numbers are at all-time highs as well. And when we look at the sector or the region, I should say, the regional breakdown, as well as the firm size, this is for economic conditions, U.S. economic conditions overall, 12 months from now. On all areas, we see improvements quarter over quarter, and we see improvements year over year. So this is very welcome news. It's like we're turning a corner here, I think, in the U.S. economy, at least in terms of the sentiment, and perhaps this will predict good things to come. So here's another slide that I think will take a minute or two to talk about. This is drilling down into the sectors again, and this is looking at future sentiment regarding each of these sectors. And this is, I think, a very interesting slide when you look at the change over prior year. So again, in blue circles are the highest future sentiment net ratings. And again, those are still in the transportation areas, wastewater and water, energy and utilities, all of those IIJA sectors. There's still stronger future sentiment than anywhere else. But when you look at that year over year, we're starting to see some softening in those particular sectors in future sentiment. But look at year over year in residential, data centers, manufacturing facilities, commercial. So here's where we're seeing real improvement in this future sentiment. And I think, Thomas, you had some thoughts on this, sort of to build on what you were saying earlier.
Yeah, and I think first, some of these heavy civil industries at the bottom, they still have very high positive sentiments. It's just they can't get much higher. And in some respects, some of it too is probably a bit of a function of the rollout of money actually hitting the street in terms of a lot of these federal funding programs just taking a bit longer to get out there, whether it's for the IIJA or IRA, et cetera. And then, as what we touched on earlier with Daphne's question, some of it is a bit of a lag, but the science, technology, industrial manufacturing have already been, performing well for 12 months. So maybe they just needed to show the industry they were growth areas for folks to get more positive behind them. I'm not exactly sure how people's sentiment is derived for that, but yeah, that all checks out and makes sense.
Well, and I think also, people in some of these, as you said, interest rate sensitive sectors
Yeah.
starting to feel a little bit better now that rates aren't going to continue to increase. And looking down the road 12 months, perhaps we'll see, interest rate cuts. And I think that could also be pushing some of these numbers up.
Yeah, absolutely.
Yeah. So you mentioned the rollout of the IIJA, and this slide, I'm going to touch on that as well as a few other things. It's a little bit busy, and I understand that. But what we're seeing here, this is the reasons for economic sentiment 12 months from now among those who think that business conditions will worsen or will not be as positive. So that number, of course, is declining because fewer people are negative when they think about the sentiment of the future economy. But among those who are negative, one thing is the rollout of the IIJA. That's one of two areas on this slide that has actually seen an increase in concern, and it went from 29% to 40%. So that kind of reflects what you were saying, Thomas, that there might be a little bit of consternation out there about the slow rollout. And we asked about this specifically last quarter or the quarter before, and the feedback we got from firm leaders was that there's not just a labor shortage among firms, there's a labor shortage within the clients as well. And there just aren't always enough people in government to move these projects forward. So it's, that I think helps to put this into a little bit of perspective. The other area that has seen an increase in concern is now the number one area of concern. It's the political environment and political uncertainty. We obviously are now headed into an election. We are in 2024. Primary season has already started. And this is again where I say we cannot separate ourselves from the world around us. And we hear a lot of talk in the media, but these concerns are real. These are concerns among firm leaders that this will actually affect firm business and industry. So I think that's a pretty remarkable testament to how concerned people are. But there's some good news on this slide as well. We see lower concern about inflation. We see lower recession concerns, even lower workforce shortage concerns. Perhaps people are just sort of like, well, this is what it is, and we have to deal with it now. And then increasing interest rates, that percentage of concern fell really, really dramatically from 72% to 45%. So a lot of interesting things here. Most of it is good news, but again, a few flags, maybe yellow flags to throw up. We also asked all firm leaders, not just those who are feeling a little bit more pessimistic about the future, but we asked all firm leaders, what are their biggest concerns going into 2024? And here's where we see what you talked about earlier and what I referenced as well, Thomas, is the continued upward pressure on wages. So even if interest rates might be coming down soon, or at least not increasing, we are still seeing upward pressure on wages. And that, I think, is more of a concern than any other type of inflation right now. But number two is political disruptions due to the 2024 presidential election. So again, this is not hype. This is a real concern that's out there among a lot of folks in our industry. There's other areas of concern as well, but again, not quite as high as what we see in terms of concerns about wages. Thomas?
Yeah, so, I think thinking to the future, I threw this together looking at when we last presented this chart on the left is how a variety of expert thinkers were thinking about, the 2024 GDP growth. Since then, there's been a little bit in December, January, February, bit of a whipsaw in terms of economic data readings coming out. But what we see is just on average, folks are more optimistic about GDP growth by about 30 basis points where we are today compared to where we were when we did this last economic outlook roundtable. And so I think that's just kind of showing a general optimism consensus amongst others that 2024 is looking to really be stable, right? That's kind of what we want, is stable growth, nothing volatile.
So Thomas, are we seeing now that these the thought leaders, if we will, in the economic space, are they now saying that we will not have a recession this year, or are they still saying, we think we're going to have a mild one?
Yeah, I mean, I think it's still like 20%, at least for the NABE. I know they asked that in their survey, and I think it's like 20% think there might be one by the end of the year, but it's not. That is something interesting that we could go back and look at for the next one to basically see beginning of 2023 compared to 2024, how they were predicting a recession.
And what's your prediction, Thomas? Because I trust you.
Oh, I don't think we will have 2 quarters of negative GDP growth.
Yeah, that's my sense as well. I mean, I don't think I can't see with the job growth we're seeing, with consumer spending holding up, pausing on interest rates. It just you can't have a recession when you have 3.7% unemployment.
Yeah, it seems really hard. So, this is something related to inflation, which has been a pretty hot topic this session. Our last sentiment survey is really looking at kind of what's happening in the supply chain. We see that just over the past 2 months, that supply chain pressure has increased a bit. And so the question kind of now is, what we showed was goods prices that actually started to turn a corner and come down, something just to keep an eye out with respect to, say, everything that's happening in the Red Sea, as well as other geopolitical risks. How is this kind of like, to go back to, what we're saying with will the Fed cut rates or not? They don't want things to be perfect, but they want the general trajectory of things to be looking good. And so there just are a lot of indicators they're looking at or considering. And, this is something that I think would give you pause, right, to continue to monitor, because if this pressure starts to go up, then we will see an actual change in the goods, which, we already know we can't get the services costs under. So it's kind of like a bit of a double whammy if goods prices actually start or continue to kind of trend upward.
Yeah, and I think, there's things that we can control and there's things that we cannot control.
Right.
When we look at those geopolitical concerns overseas, they can affect us. We saw that, right? And so that's something that we just always have to keep an eye out for. And we just, who knows what's going to happen with Russia? Lots of saber rattling over there, and that can certainly impact us. But you have some other things that you want us to be watching out for as well, Thomas. What are those?
Yeah, so we've talked about this a bit, and there's not a great consensus in terms of how the commercial real estate sector is going to be shake out over the next 18 to 24 months. But we brought this up last time. There is a lot of commercial real estate debt out there that was very negatively impacted by the quick rise in interest rates. No one is concerned it's going to be an all-out crash, but also what we see in some of the sentiment, even though commercial real estate maybe is improved, I think it was still a negative overall outlook for it. And so this is just looking at the foreclosures over the past decade. And, you really see from 2023 onward that increase in slope in the number of foreclosures. It's just something to continue to monitor right now.
Okay.
And then, this is something that I think might come into the forefront a bit more over the next year or so, is really what's happening with productivity. And, as I mentioned, AI was the hottest word of 2023. That is going from being talked about to really being part of most folks' day-to-day work. And so that labor productivity, to what you were talking about with our labor force participation being lower, essentially, can we get more output per worker with these technological advances? We see there was a bit of a drag in 2022. That's definitely correlated with some of the less robust GDP growth. But really, over the past few quarters, it's starting to pick up a bit. And so I think this is one of these, I wouldn't say silver lining, but just real positive thing to consider and keep in mind is, you asked, will GDP contract or not? If we're continuing to get, high labor productivity, then, signs are pointing towards it not contracting.
So lots of good news, a few things to watch out for. A few other data points we have from our sentiment study are backlog, anticipated future backlog. Our trend is continuing to be positive, and it's getting even more positive. So just another indicator that the economy and that our industry is doing very well right now. And when we look at the status of hiring going forward, we actually see that more firms are even more positive about hiring in the last quarter than they were a year ago. So we have a labor shortage. We are hiring, I think, as fast as we can, but there are still more jobs out there that need to be filled. And that's, I think, another continuing story that we've seen it from 2023 that we're going to still continue to see in 2024. In the next quarter, quarter two, we are going to ask again about actual increases in wages from our firm leaders. And we'll have a reading for you in the next quarter at a spring conference or at the annual meeting on that metric. So the last thing I want to share with you all before we round this up and take any other final questions is that we have continued to do our work in looking at the metrics from our business sentiment study and how, if at all, they can help us to predict the future in other areas. And we continue to see a very strong correlation between current sentiment regarding the U.S. economy as well as future sentiment regarding the U.S. economy. We also see that two other metrics, our industry future sentiment and backlog future sentiment, all of these are highly correlated with these other macroeconomic indicators, and they lead them by 1 to 2 quarters. So what that means is that we now have an actual predictor in the data we're collecting as to what's going to happen with GDP, employment, housing starts, housing permits, as well as inflation over the coming 3 to 6 months. And all of these metrics that I'm talking about from our study are improved. They've improved this quarter. So what that means is that we should continue to see improvement in GDP, employment, housing starts, and permits, and also inflation. So this is all very good news for the economy and for the industry. All right, so I'm going to just sort of wrap it up here with, what do we see on the horizon? Well, consumer spending remains strong and it's powering the expansion. The lack of workers is certainly inhibiting firm growth and profitability. We're doing well as an industry, but if we had more workers, we could be doing even better. Inflation concerns are certainly easing, but the Fed's not likely to cut rates anytime soon, at least not in the next 3 months, I don't think. We'll have to see how things shape up for the summer. Housing market has stabilized, but still, the rates are a bit elevated. And so we have a lot of people who are sitting in their homes. They're not planning on moving anytime soon. They have great interest rates and they're just not interested in moving. But the demographic demand remains strong. So, we'll see how that goes over the coming year. And then recession concerns keep getting kicked down the road. Thomas and I don't think we're going to have a recession this year. It just doesn't look likely. And all the indicators that we're seeing, including additional data that's in the report, the sentiment study report, is indicating that, we're not going to see a recession this year. Daphne, do we have any final questions before we close up?
I think we have answered the questions. But I want to thank you, Thomas and Joe, for providing all your insights, for pulling together all this great data. Thank you so much to you, our participants, and especially those who completed the survey, because otherwise we wouldn't have all this great data. So I strongly encourage you, when you see that come across your desk for Q2, please take a few minutes, let us know what you're thinking, help us understand the insights. The sponsors of the ACEC Research Institute, obviously we could not do any of this work without them. So we are very thankful to this group of folks who are providing the financial support for the Institute. Welcome others to join. We'd love to fill this entire screen. So please reach out if your firm or you personally are interested. And on the next slide, Joe, I think we've got the QR code. So if you want to scan this, you can go and get the full report on the engineering business sentiment, as Joe just alluded to. It is now up and ready, so you can download that and have a full read through. And then I just wanted to give a quick shout out. Next week, we have a joint session that we're doing between the Institute and ACEC called Engineering Your DEI Journey. It's going to have client perspectives and industry progress. So we have DEI and B experts, we have firm leaders, and we also have the Secretary of Massachusetts Department of Transportation joining us to talk from the client perspective. So I think it's going to be an interesting session. Encourage you to go to the website and register for that if you haven't yet. It is going to be a complimentary joint session between the Institute and ACEC. With that, I think we are ready to wrap up right on time. Thank you again, Joe and Thomas, and thank you all for joining us. We look forward to seeing you next time. Have a great day.
Thank you.